All right, welcome to the Monday edition of the On the Tape podcast. I'm Dan Nathan, joined by Liz Young-Thomas. She is the head strategist at SoFi. If you didn't know that by now, hi, Liz.
Hello, good morning.
Yeah, and Guy Adami, that would be Guy Christopher Adami. Welcome.
I'm not the head of anything, but I'm happy to be here.
Yeah, you are. You know what I did to my head this morning? I was in a rush shaving. I nicked something right under my lower lip, and it's just kind of still bugging me. Great Thanksgiving here, people.
Great Thanksgiving. Absolutely wonderful. My apple pie turned out wonderfully. Thank you all for asking.
Look at you.
And your Packers won. Guys, Giants. I mean, the lowly Giants, not particularly pretty, but you have hockey to kind of focus on with the New York Rangers.
Yes, we do. Yes, we do.
All right, let's do this. Busy week. You know, last week was that holiday shortened week, right? A lot of folks can kind of push stocks around, and that's what they did in a whole host of areas. We had some very interesting November performance this year. I think it was the best November for the S&P since last November, the best NASDAQ since November 2022. We have some earnings. We have some CEOs stepping down, kind of an interesting one over there in Intel. And then Liz, this is your baby. Lots of data this week. Guy, where do you want to start?
Well, the last week, the Friday, just sort of, as you said, not a lot of volume, people able to push things around. And the S&P, as we're sitting here right now, making a new all-time high, almost 6,050, and all those $6,100 price targets that we've talked about earlier this year seemingly are coming to fruition. So, it's just the resilience and just sort of this upward trajectory of the broader market continues to, at least in my opinion, sort of dazzle and defy some logic.
Yeah, Liz, it's interesting when you just look at this chart. Guy just said 60-50 in the SPX here. Look at the kind of sell-offs that we've had peak to trough over the last, few months. Since that August low was down about 9.5% or so. Then we had the September one, which was nearly half of that. Then we had a little sell-off into the election, which was half of the prior one. It is just bottom left, upper right. Do you think that these strategists that we've been detailing with their kind of year-end price targets, which have been notched up, and then their 2025 targets, which have obviously been notched up, none of them are too aggressive? I think there's very few calling for much over 6,700 or so. Do you think there's getting too much euphoria? Our friend Doug Cass over there at Seabreeze gave me some data. His assistant last week was tracking pundits on CNBC. He said all 38 in which he was tracking were all bullish, which, again, purely anecdotal stuff. But I think that's interesting. And let me tell you something. After those November performance stats that we just kind of gave, it's kind of hard to see otherwise that the December performance would be, I don't know, disappointing.
Yeah, and honestly, I think Tom Lee was on today saying that when you have a year like this where you've got post-election rally and you've got an up year, December is 100% of the time positive. I might have that stat a little bit off, but the momentum is clearly here. And I don't think it's just anecdotal that you've got 38 strategists or whatever Doug was tracking on CNBC saying bullish things. It's really difficult right now to come out and say, oh, we can't believe in this rally. I mean, you've got the S&P up like it is. You've got Bitcoin rallying. This is clearly a risk on market. And even when you look at sector performance, I mean, certain sectors that weren't necessarily doing all that well for parts of the year now suddenly coming back. We've got a lot of sectors and stocks really carrying weight. And the internals of the markets, when you look under the surface, the number of stocks trading above their 50-day, above their 200-day, it's just there. The strength is there. And it's really difficult to come out against that. It's easy to be a contrarian, I suppose, in that environment, but it's difficult to make points that back it up right now. So I think we're going to continue hearing this optimism. I talked about this right after the election, not just what we're hearing in commentary, but the surveys and the soft data, basically the vibes that you're going to get out of data. Everything that is a survey where you're just calling businesses or calling consumers and asking them how they feel about stuff is going to be positive, more likely than not, at least through the end of the year, just because of how everybody's feeling.
Yeah, Guy. And so we had 23% gains in the S&P last year. It looks like we're on pace for something above that right now. The S&P is up nearly 27% of the year. We talked about it with Danny Moses on Friday afternoon. People forget 95 through 99. That was 4 years. We averaged 25%, returns. And, think about how that all started. I think it was back in 95 where Fed Chair Greenspan back then in 95 was saying that the markets were demonstrating some irrational exuberance. And so my question to you is that okay, we've been talking about the concentration in the S&P and the NASDAQ, and it's related to going back 2 years to the launch of ChatGPT 3.5 that really got a lot of these major tech names going. Just think of the market cap that has been created around this narrative. I think it's probably $5 trillion. But I guess the question, and not too different than the mid to late 90s, what if this generative AI thing starts to infect other parts of the market? Is that what causes the sort of run that we had the mid to late 90s? Because it is pretty similar for all intents and purposes.
Well, that's clearly the hope. And you talk about timelines. Think about this: about to be approaching the 5-year anniversary ish of that March 2020 low, which is remarkable to think about. And where did the S&P trade down then? Around 2000 or so, either side of 2000. So over that period of time, we have seen a similar type of performance that we saw in the mid to late 90s. So it's not like it's unprecedented stuff, to your point. To answer your question, yeah, I mean, I guess AI could be sort of the final driver of this thing and sort of the, more gas in the tank in terms of what it does for performance of companies, what it does for profitability, what it does for productivity, and all those things. But wait, with that said, Dan, there's only been a couple that I have seen of really mainstream companies utilizing it in a positive way. And I've mentioned this a couple times. It comes in the form of Facebook, which has talked about it now for 2 quarters, and obviously what Walmart's been able to do with it and being able to drive their margin growth that they've seen, which is what allows them to have the premium multiple that they're trading at. And I'm sure there's smaller companies that have implemented, have done well with it. But in terms of the big mainstream companies, those are the two that sort of jump out to me. So it remains to be seen if we in fact see the monetization on the back end. But right now, the market's clearly pricing that in.
Guy, I think you're probably pretty confident about this. At one point in the next few years, Liz Young Thomas is going to be tagged with some sort of major market euphemism, but that takes me back to John Templeton. Do you remember this quote here? Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And you go back to nearly 5 years at that March 2020 low. I mean, talk about pessimism. I don't think any of us have seen that sort of short-term pessimism. But Liz, there is Bank of America is out with some data here. They're still they're bullish on the current rally. In a note, SPX in 25 will likely have another big double-digit move. Falling bond yields equals secret sauce for SPX to avoid huge reversals seen, and they go back to some periods, catalyze further big equity gains as occurred in 97, 98, which is kind of what we're just talking about. Let's talk about yields for a second here, right? So we had that move that a lot of folks, maybe not Guy Nostradamus over there, were kind of scratching their heads when we had the Fed cut interest rates by 50 basis points. It looked like they were going to embark on this massive rate cutting cycle going into 2025. And then all of a sudden we see right around the time that they cut in September, they saw the 10-year bottom out at 3.6, go as high as 4.5. Here we are about 4.2. So can equity gains kind of count on a rate cutting cycle in 2025? Because if you look at the CME Fed Watch tool, we have for the December 18th meeting, I think it is, a 62% probability of a 25 basis point cut. That's probably the lowest it has been over the last month or so.
So first of all, let's go back to the John Templeton quote. If you look at PEs, so just the forward 12-month PE, and this is all a matter of how do you define optimism? How do you define euphoria, right? I think we can all probably agree we're somewhere in one of those categories. So if you look at the forward 12-month PE or even the cyclically adjusted PE, which is a longer term view, maybe a little more accurate, both of them are high compared to history. Neither of them are quite as high as they got right after we reopened and had this big boom in the stock market. So end of 2020 into 2021. And certainly neither of them are as high as they were back in the dot-com bubble. So if we're defining euphoria as the dot-com bubble, we're not there yet. I would say this is more of an optimism time, which is why I think you're also seeing all the strategist price targets for 2025 come in what I would consider a safe zone. And that safe zone is right around the average annual return on the S&P 500. So I think if we had to categorize it, we're probably in optimism. People are concerned that the bull market might mature here, but not be over, not turn into some sort of bear bubble bursting euphoric situation. So that's that. So what's happened with yields when we look at just the movement in the 10-year now, and Guy, again, I know you know this, but we are inverted again as of
Yeah.
this morning by about 1.2 basis points. So the movement in that 10-year, and we've talked about this before too. We got up to 4.5 in the 10-year. It got completely rejected back down to now we're in the 4.2s. I continue to think that the equity market is fine with the 10-year until it gets to 4.5. If it gets above 4.5, we start to think that it's for bad reasons, and we know what those reasons are: inflation reigniting, deficit problems, so on and so forth. So I think it will continue to get rejected at 4.5 unless we can confirm one of those bad reasons is true. Now, your other question was, can we count on the Fed for rate cuts in 2025 to fuel the equity market? I don't think we can, at least not at this point. So we got the minutes from the Fed last week. They sounded a little bit dovish because they reduced the reverse repo rate by 5 basis points, but we still are only expecting in the market 2 cuts for all of 2025, which is not a lot of cuts. We came into 24 expecting 6 cuts. That did fuel, I think, some upside in the market. Now we might get 4 by the end of this year, and we're only expecting, so that means that we're expecting 6 for 2 years, for 2024 and 2025. So that's obviously not what the market is going to trade off of as some sort of monetary loosening as its gasoline. So we need this cyclical piece of the economy to continue running. We need growth to stay strong, and we need inflation to stay under wraps.
Guy, why would any of those things not occur if you think about all the stimulus that is expected and the tax cuts extended under the Trump administration? At least that's why folks are buying stocks right here.
Well, that's why folks are buying stocks, clearly. I mean, why wouldn't that take hold? Well, I mean, I think Liz would agree with this as well. You continue to throw stimulus, tax cuts, lower interest rates, and what I think is going to wind up happening is that inflation genie that people think is somehow back in the bottle is just going to escape once again. And in terms of yields, I agree with Elizabeth. 4.5% for whatever reason seemed to be a bit of a line in the sand. But if you just look at this through the lens of the TLT, it's not a very constructive chart over the last couple of years. It's been basically upper left, lower right since that aforementioned March of 2020, as yields have basically started to rise. I still think, Dan, and I might be in the minority here, but I think the levels that we saw in the fall of 2023, and I think that was around 83 or so in the TLT, and that probably equates around maybe 5%, a little bit less if I had to guess, but I think that's going to be visited at some point. If it's not in December, I think it's going to be early next year. And one of the reasons I think that, because you can tax cut all you want, you could try to lower interest rates all you want, but the debt issuances that are coming in 2025 are going to be extreme. And I think the market is not prepared for that. Now, again, not to suggest we're going to have failed auctions. That's not my point at all. But one thing that I've said for a while is the market's going to demand a higher rate of interest to buy our debt. And that's been true here and there through in 2024, not as much as I thought, but I think you're going to see more of it in 2025.
Yeah, and again, the Fed seems to be targeting the neutral rate, so maybe they're getting comfortable with a level of inflation that's gonna stick. And, again, we've talked about the cumulative nature of inflation over the last 4.5 years or so. It's obviously putting stress on parts of our economy, parts of a consumer that we've been detailing. I don't know that they've been, strong for, let's say, many years since like PPP and all that fiscal stimulus that we saw. So again, a bunch of that stuff is probably weighing on a part of the economy that might keep inflation bid if you see risk asset appreciation like this, and then you see the higher end. We've talked about this K-shaped sort of economy or recovery, if you will, a higher end consumer and a business community that seems emboldened to continue to reinvest and invest in CapEx and, the like. So again, Guy, you say this all the time, the inflation story is not done despite having CPI or PCE below 3%. And, again, the Fed's been saying on its way to its 2% rate. Liz, this week, a bunch of economic data. Obviously, we have jobs at the end of the week. What is some of the stuff that you're most focused on that you think might be market moving?
Yeah, so we're recording this right now. It's 9:45 a.m. By the time this comes out, we will have ISM manufacturing PMI and some of the other data that comes along with that report. We get services PMI on Wednesday of this week. Both of those would fall into the category that I mentioned earlier. These are surveys. These are companies responding, saying basically how they're feeling about prices paid, how they're feeling about orders that are coming in, how they're feeling about employment, I would expect these to come in positively. And manufacturing, if we remember, since the pandemic was something that kind of got down in the doldrums, couldn't quite get out of that space. And we're still technically in the manufacturing sector below neutral. So 50 is the neutral measure, but it is expected to improve this month. So I think you're going to get some good information out of that. Jobs data, obviously on Friday, but JOLTS comes out first. We get JOLTS data tomorrow, which is job openings. And that's been something that we've been watching closely. So that could be a little bit of a market mover just from a Fed perspective, expectations of what the Fed might do. And then the rest of the week, I mean, I think after that, the jobs data is going to be the big whammy that we'll continue to keep our eyes on. It's not expected to be anything super surprising. Unemployment rate is expected to stay at 4.1%, where it's been for a while now. Things that you want to watch there in particular, you want to watch average weekly hours, you want to watch labor force participation, and we will cover that probably ad nauseum after the report comes out. So fear not, I will talk about that next
So,
Monday.
real quick, Elizabeth, as she was talking, and she's not able to do this at the same time because she's focused on the conversation with you, Dan. But so PMI came out for November. U.S. manufacturing PMI came out at 49.7. Previous number was 48.5, and I think the street was looking at 48.8. So good number. I mean, good in terms of better than expected, which suggests things are, again, not deteriorating, which again suggests that yields probably should start to tick higher. So the first thing, of course, that I do, Dan, is look at the TLT, and it's sold off a little bit. So now you start to connect the dots, and she's right to point that out. So this economic data suggests to me that rate cuts really are not necessary. And again, we've talked about this for a while. It's like, be careful what you wish for. Lower rates just for the sake of lower rates doesn't really help. Well, I know it helps. It helps the people that own things and the people at the top end of the food chain. It doesn't help anybody else.
Yeah, and the dollar's rallying today, a pretty decent rally here. So, yields have caught a little bit of a bid, maybe up 5 basis points. And brings me back to the VIX guy. It's up today a little bit. We know that after a holiday shortened week, you have some air come out of volatility. So, it's still below 14. You put that together with the potential for, let's just say, if the probabilities of a rate cut continue to go lower, you're going to have a VIX that should be going higher, in my opinion, for all intents and purposes, because you'll have a dollar rally. I mean, these are the sorts of things that could be headwinds, right, to U.S. corporate earnings. What are the things that kind of temper a little bit expectations for corporate earnings? I mean, if we saw a cycle in which strategists had to start bringing down their 2025 earnings growth estimates, that's when you'll see those S&P targets come down. It should be that case. Now, the dollar might be tough here because you see what's going on with the euro related to France and the potential for, some sort of issues with their government. The right-wing government is kind of threatening, if they don't get budget cuts and the like. So, that's interesting to keep an eye on, but the euro might be placing a little bit of pressure on that. Let's focus on some single names here. We're going to get some earnings, but I think right out of the gate, Guy, some of this news on the chip front. So the Biden administration is really leaning into some of these chip restrictions on China here. It seems like every week we have a new one, and then, put that on top of what, we started last week with President-elect Trump suggesting about tariffs across the board on Chinese imports. But, Guy, if you look at some of the chip stocks here, you have Taiwan Semi almost up 4%. You have NVIDIA bouncing, 1.3%. There was a day last week, I think it was on Thursday, where NVIDIA was trading very poorly at its lows. It was down maybe 14% from those post-earnings all-time highs from a couple weeks ago. And so it seems like the chip sector is not having problems with increased rhetoric around restrictions or tariffs.
Well, it's interesting. Taiwan Semi, which made its all-time high a little bit, I think, Dan, before the week or two before Halloween, north of, I think, 210, traded down to your point. I mean, it had a rough week last week, but it's back on its horse. I think it got down to almost about 180. So that seemingly is a bounce to me off a bit of an oversold condition. And again, maybe just some of the air had been taken out of these names. Maybe there's some sort of, I don't know, re-acceleration to the upside in terms of dollars, investment dollars, and passive money and those types of things. With that said, the biggest story today, and I know I'm not looking to bury the lead, but the fact that Pat Gelsinger is stepping down from Intel, and I think that was announced over the weekend or earlier today, That to me is fascinating because, we talked about before this show. I don't think anybody necessarily saw it coming as fast as it has. Now, he's clearly been on the hot seat. And, you're talking about, if you're looking at Intel in terms of an NFL team, this is a team basically right now that's 2-9, headed for the first or second pick in the draft. And some heads have got to sort of roll. And I think that's what we're seeing now. So semis are still in play without question. I think the market is getting comfortable with the language around tariffs. I think that people assume that they're going to be bargaining chips, and there's probably some truth to that, but I don't think it's entirely true, and I don't think the market's prepared for that.
Yeah, the thing that's interesting about the Intel is that Pat Gelsinger was brought in a few years ago to be kind of the savior of this company, turn it around, invest in foundries. So basically making factories to make the chips. This has been a fabless company for a very long time. They were expected to get nearly $9 billion in capital from the CHIPS Act to kind of help build that out. Think about $9 billion on a $107 billion market cap company. That is considerable, right? When you think about it, and the fact that they just have not been able to get their act together, and that the CEO was like left the day of. I mean, literally, they announced it this morning and he's out as of now. He's off the board. The company has announced 2 interim folks to be the CEOs until they find a new one. I suspect that's probably an attractive job if you think about it. It won't be an Intel insider. It might be, a turnaround guy. The other thing we got to remember is that Qualcomm, there was a rumor, I want to say a few months ago prior to the election, where Qualcomm and Intel noted to possibly merge. Qualcomm addressing the rumor. Most of the time, you do not see companies address merger rumors, and they said, we're not going to make any comments about this until after the election. So maybe this kind of opens the door for that sort of merger. But you and I have been talking about also that Qualcomm, where they're positioning for Copilot PCs or AI-enabled PCs, they had some pretty, not great data about that or commentary around that. So that was one of the reasons that you would be buying a stock like Qualcomm. Liz, we want to talk about something that you've been all over for a while, this relative underperformance in software stocks relative to semis, right? Over the last, let's say, year and a half or so. But now we've seen that flip over the last few months, and we've seen the SMH ETF that tracks the semiconductor index, which is 30% weighted towards NVIDIA and Taiwan Semi. Despite those stocks' strong performance over the last few months, we've seen, the SMH go sideways. It's down, I think, about 13% from its all-time highs made in June. But you've seen a massive breakout in the IGV. Maybe it's a bit of a catch-up trade. That's the ETF that tracks software. But last week, it had its worst week of performance. This is per Jefferies versus the semis in a very long time. Thoughts on that reversal if the semis were kind of to re-engage as the leader within the tech sector?
Well, I think there's going to be volatility around semis just because of the news cycle that's coming out. Obviously, we've got this new stuff from Biden today. And then in 2025, I think there's going to continue to be a news cycle that's just choppy about semiconductors. I still like software, and a few days of a pullback does not scare me off. And frankly, if you look at even a longer term chart, when I say longer term, I'm saying 6 months or even year to date, it just looks like we sort of flatlined in software for the last week or so. So it's not this big dramatic sell off. Now, I still think that it's possible we get a little pullback in software because of what you mentioned. We've had this huge rip higher in the IGV. So maybe we give a little bit of that back at some point just to get more rational. But into 2025, I still think software can be a really big beneficiary of investors who are taking gains from the semiconductor space, or investors who are starting to say, you know what, all of this earnings momentum that we've seen out of the likes of NVIDIA and some of the other names for the last couple of years just can't continue at this speed. So where else can I find growth? I can find it in something that has underperformed semis, but is still in the technology sector and can produce growth. And the other thing I would say is you have to think about where companies are going to get money to spend on making software earnings get better. So if growth in 2025, broad economic growth, is better than we thought, now that we have clarity about the election, if people are expecting, if CEOs are expecting lower regulation, a friendlier business environment, they may be more willing to spend on things like software, where for the last couple of years, companies had been so focused on spending on AI. So if they start to spread the spending out, I think software is a big beneficiary of that as
Yeah, and
well.
first of all, Elizabeth was early and right on that. I just want to point that out. And if you look at, this, Dan, but a lot of these chip stocks, it was July of this year where things started to sort of roll over to the downside. Not to suggest that they've cratered, they haven't, But a lot of these saw their all-time high and 52-week highs right around that time, number one. Number two, that sort of coincided with this reemergence. And, maybe the investment dollars in terms of investors are starting to go to the space. And maybe to Elizabeth's point, you'll see sort of the CapEx money sort of make its way back. With that said, for example, an Oracle, which made an all-time high, I believe, last week around 196, very quietly has gotten itself to a $500 billion company. These have all been remarkable moves sort of underneath the cover of darkness, but they've also gotten themselves a little bit expensive as well. So the question one has to ask, and there may be some more room on the upside here in the software names without question, but things happen on the way higher in the way that we've seen it. And what happens is stocks get expensive. So it's going to be really vitally important for these stocks to sort of acquit themselves vis-a-vis earnings. Otherwise, these valuations, I think, are start to be questioned.
Yeah, good barometer on that this week. So Tuesday after the close, Salesforce.com is reporting earnings. Now, again, I want to go back to the summer of 2023 when all of these software companies were telling a story about generative AI and what, products and services that they were going to be kind of implementing this technology. Salesforce was one of them. Salesforce, that was like the top. Literally, the stock got killed over the next 9 to 10 months or so. So the stock this year is up 26% of the year. A lot of that coming in the last few months. So I think that a lot of what you guys just detailed about this kind of switch from semis to software, this has been a beneficiary of it. I think about what you just mentioned, Guy, about valuations. Okay, so here's a stock that is expensive. It's always traded expensive. But think about this. It's rallied 56% in the last 5 months off of the lows. I just said it's up 26%. Now it's up in line with the S&P and the NASDAQ. It's trading at all-time highs for fiscal 2026. Okay, so that's basically 2 quarters from now. Expected EPS growth of maybe 11-12%, in line with what many strategists, right, are suggesting for the S&P 500 on 9% sales growth. It's trading about 30 times. We know the S&P is trading about 21 and a half times. So Liz, my question to you is like, why would anyone pay 30 times versus an S&P of 21 and a half times for the same sort of growth with a stock at all-time highs? I mean, to me, it doesn't make a whole heck of a lot of sense unless their earnings were about to inflect for the very reasons that Guy just suggested, because you're going to get added growth from generative AI used across their products and services, and their customers are going to be willing to pay for that.
Well, I think there's a lot of justification for valuations going on right now, just along the lines of, I don't want to miss the next 10 times up. And we've seen stocks do that. We've seen stocks enter overbought territory and continue to rise. We've seen entire sectors do that. I mean, I remember when consumer staples was in overbought territory and it continued to get more and more and more overbought. So now if you look across even just the entire S&P, there are a number of sectors that are overbought. So I think to Guy's point, we are extended on valuations compared to history. I don't know if investors feel like we're extended on valuations based on our own optimism right now and just looking forward the next 12 months. I think there is so much optimism built into that people would look at a valuation and also don't underestimate the power of what we've seen play out with something like Nvidia or even just the Mag 7, those concentrated names, and how much money people have made in concentrated spaces, and the desire to want to find that next big thing. And I think investors are going to continue going after that unless something changes.
Yeah, we saw that last week, Guy, with Snowflake that gapped up
Mhm.
33% from very near, a 52-week low. The stock is still down maybe 12, 13% on the year. But the story here was they kept on talking about AI and their implementation in their products and services. So again, to Liz's point, don't underestimate the potential for investors to kind of chase some crap. All right, we covered a lot of ground here. I guess just to wrap up, we're focused on some economic data this week. We're focused on some seasonal trends and kind of universal bullishness into the end of the year. And then we're also focused on a little bit of earnings here. So again, pretty interesting stuff. Liz Young Thomas, thanks for being here. You're going to be back with Guy and me on the market call on Wednesday, live at 1 o'clock. And then Guy and me, you're just going to have to suffer through us all week. We got a lot of good podcasts and market call here, and we're really excited to see how this year will end.